Good evening, my name is Dominic Williams, and this is my presentation of Week 4, Capital and Risk. This is for AMU Business 604. The instructor is Dr. Schreiber. Once again, my name is Dominic Williams, and at the very bottom of the introduction slide, you're going to see a link to this video. So the agenda, things that we'll be covering today, we're going to talk about sensitivity analysis. What is it? We're going to cover the quantitative and qualitative steps that go into developing a sensitivity analysis. We're going to talk about capital budgeting analysis, and we're going to discuss how risk plays a factor in developing this. Before we go further, does anyone have any questions on who I am or what we're going to be covering? Okay, please at the end of each slide I will give an opportunity to ask questions. Just hold them until the end. So sensitivity analysis. So a business case is a set of assumptions that a business makes in the absence of fact. Some assumptions can be made confidently and are backed up with facts, data, and historical trends. Other assumptions are founded in experience, aka a well-educated guess. There's no expectation to have 100% accurate assumptions all the time. Sensitivity analysis is an evaluation of how sensitive certain measures are to changes when making these assumptions. Understanding the degree of sensitivity helps you understand the potential impact of assuming, and it turns out to be wrong. You should always ask yourself, if this assumption turns out to be wrong, how bad of a situation could this put me in? Sensitivity analysis is important because it allows you to identify risks, compare severity of risks, and then focus on mitigating those assumptions that are either riskier or would place you in a more grave situation as compared to something very minor. Sensitivity analysis is designed to save time, money, and professional reputation. Your level of trust and credibility may be eroded over time with consistent poor results based on assumptions that negatively went against you. Sensitivity analysis is conducted by objectively reviewing quantitative and qualitative data, which provides decision makers the information they may need. Assumptions are drawn from the information or lack of information, and the business case is formed and ready to be discussed amongst the decision makers. So we're reaching into this slide. Are there any questions? Okay, if there's no questions, we're going to discuss in more detail the quantitative and qualitative steps which lead to developing your sensitivity analysis. So your quantitative steps, we're looking at which numbers are important. Which numbers are important will depend on the scenario that you're attempting to build. As a general basis, you want enough data to cover a long enough period of time to demonstrate trends that can be compared with other similar scenarios. If you're in the business of selling t-shirts, for example, you may want to collect numeric data on prices of materials, prices to ship materials to your warehouse, operating expenses to keep the warehouse and production going, average sales yearly over the past 5 years, etc., etc. So what? This numeric data provides you a starting point when conducting sensitivity analysis. These building blocks create a realistic scenario that you can play the what-if game with. Some information will come easy, like the price of raw materials. Other information you may need to guess in order to see what could happen. An example of this is interest rates during a certain period of time because these are subject to change. Determining what would happen comes down to evaluating probability. The degree of certainty you have that your assumption will turn out correct, paired with a consideration of how positive or negative the outcome could be, will aid you in coming to a decision. So as you can see in the graph, if you're operating in the green, it's probably a relatively safe assumption. But if you're operating in the orange or red, it's something that you're probably going to want to pay a little bit closer attention to. Because if it goes against you, again, it could erode your professional credibility and eat up some of your time and money. So qualitative steps specifically. Qualitative steps in sensitivity analysis evaluates the quantitative data being presented. At this point in sensitivity analysis, you're questioning the information you're given from several perspectives. Is the research valid? A A medical company that's releasing a new drug that conducts its own research is expected to control the narrative and maybe ignore some of the negative results that they found. They would only highlight the good because they need to get paid and return the investors their money. If the researcher is not a professional in that area, their credibility may be called into question. So you may ask yourself, what qualifies this person to tell me anything about this topic that they know nothing or not enough about? When data was collected, it should contain a quality spread and be compared over weeks, months, or years to give the best results. Taking someone's research at face value without question is a dangerous game to play, especially when working with an investor's money. Always question the validity of information presented. They did the hard part by conducting the research. Now your job is to question that research to ensure that you're making the right decision. Ignoring quality. Quantitative data without quality is a waste of effort. Being presented with numeric data does nothing for you if the data is skewed, inaccurate, or does not apply to the specific situation at hand. You place your career, your investors' money, and the namesake of the business at stake when you ignore qualitative evaluation. Capital budgeting analysis. We're going to talk about how risk plays a pivotal role in developing this. How do we invest a small amount of money and grow it to make us more money? That's our goal. Investors want to avoid risk. What will entice investors to assume some risk is when their potential return is significantly higher based on the money they put in up front. The key word is potential. There's not always a guaranteed return. This is where sensitivity analysis becomes important. Risk factors. So we're thinking payback period, maybe interruptions in cash flow, market swings, etc. There are innumerable what ifs that could make this a great deal or not. It's on the financial analyst to research these what ifs and determine the probability that the investment becomes profitable. Identifying a worst case scenario, best case scenario, and most likely scenario are great ways to manage expectations. So from the pyramid at the very summit, these are your more risky. However, they're going to have higher returns. Towards the middle, these are your middle of the pack, and then the base, these are your least risky and are going to provide the lowest return. But let's get into some of these. So bonds, relatively low risk, low reward. They will make money. However, it's not going to be much, and it's going to take a set amount of time for the investment to mature. When we talk about middle of the pack, we're thinking residential real estate requires considerable market research, may require an additional investment for repairs or upgrades to increase home equity, property management if the decision is made to rent the property for long-term returns. Sensitivity analysis starts to play a larger role because there are so many what-if situations with real estate. It's more important to examine these uncertainties to determine if this is a good investment if the worst-case scenario were to happen. At the very pinnacle, we have things like the stock exchange. It's completely determinant on market changes and the business's decision makers, creating revenue and increasing the value of the stock. Most investors will have nearly zero influence on increasing their return on investment and are reliant on factors they cannot change to make them a profit. Only through pure luck or intensive research can you predict a return on your investment. Here we have our reference sheet. At this time, I'll open it up for any final questions that we may have.